Good evening and welcome everyone to Series 5 of the Black Wealth Attainment and Retention Program. We refer to our program as BWARP. Today's topic is Invest Well and Live Well. The purpose of BWARP is to provide information, tools, and resources to help close the wealth gap between the Black community and the white population. We began our journey by addressing Black wealth in a white economy, an overview of the history of the challenges that we faced and the potential solutions that we could pursue in attaining and retaining legacy wealth. In honor of National Minority Health Month, we presented Wellness is Wealth and addressed the value of good mental and physical health and how healthy habits can pay dividends in our life. In Workshop 3, we laid the foundation for home and business ownership through access to capital, asset protection, smart spending, and sound tax strategies. Then we reminded some and alerted others of the importance of a comprehensive estate planning and understanding fiduciary responsibilities in what we called I Will If You Trust Me. Without a living trust in California, the pain of passing can be magnified by the confusion and conflict among family members. Needless to say, a third of your wealth will be captured by the state. Our final BWARP presentation on December 8th is entitled Millionaire Millennials. And that will be facilitated, I should say, by three of the sharpest young financial minds our city has to offer. Kevin Jackson. Kevin graduated magna cum laude from Cal State University, Long Beach. He obtained his law degree from the University of San Francisco School of Law, where he received academic honors during his 3 years of attendance. And then we have Catherine Shirley. Catherine holds a bachelor's degree in accounting from San Diego State University and a master's degree in business taxation from the University of Southern California. Along with Justin Lacey, who you'll hear from later this evening. They'll address keeping your legacy alive, making business work for you, and how to invest smart and spend wisely. And they'll do it all from a millennial's perspective. So please make sure to encourage all the generations in your family and in your neighborhood, the boomers, the Gen Xers, and the millennials, to register and join us on December 8th. Before I go any further, I want to thank the Los Angeles Urban League, its president and CEO, Michael Lawson, who you will hear from at the end of tonight's presentation, CEO Brian Williams, and their entire board and staff for supporting this program. I also want to thank the Parkside EDC board and all of our speakers for their support and commitment to BWARP. We all know about the Los Angeles Urban League and its legacy of service for over 100 years, fighting for justice and equality in our community. But you may not know that for the past 20 years, Parkside EDC has distributed $20,000 annually to scholarships and presented financial literacy workshops to deserving students and their families in our community. BWARP is an extension of that financial literacy program. BWARP is extremely fortunate to have had a group of expert presenters and guests in their respective fields who are longtime supporters of Parkside. We want to thank Dr. Zuri Morel, who is chief of colorectal at Cedars-Sinai, and the renowned psychologist, Dr. Gloria Moreau, for participating with us this year. Then we had tax and real estate specialist David L. Murphy and retired banker and business strategist Daryl Brown, followed by estate planning and trust attorney Caprice Collins. And with her was the first Black registered fiduciary in California, Dr. B.J. Hawkins. We want to thank all of you for your contribution to BWARP, and more importantly, your contribution to your community. All of the presentations that we've had in tonight's presentations can be viewed at laul.org/BWAARP. And as always, throughout this workshop, you all have an opportunity to submit your wealth building and retainment questions into the chat that will be answered during our Q&A following tonight's presentation. Tonight, we're going to gain some insight on how to invest well and live well. Our first speaker is Mr. Joe Haywood, President and CEO of Haywood and Associates, a comprehensive financial planning firm. Joe has provided investment and insurance solutions for more than 250 clients and manages more than 75 million in assets. Joe is a USC alumnus, a member of Kappa Alpha Psi fraternity, but more importantly, he's a husband and father of 4. And even more important than that, he's executive pastor of New Vision Christian Fellowship. His hobbies are golf, racquetball, and travel. And pre and post-COVID, you'll find him at the City Club, hosting clients at a table near his wine locker. Ladies and gentlemen, please welcome Mr. Joe Haywood from Haywood and Associates.
Joe, you can unmute yourself.
All right. Thank you, Brother Joe. I truly appreciate that. I want to thank Los Angeles Urban League as well as Parkside EDC for putting on this event. And I also want to thank all our viewers who took the time out to learn something about financial planning and investing. Without further ado, because I know I got to get through a lot of slides, we're going to talk about financial planning basics. And then later after me, Justin will talk about investing in particular. So some of the ground I hope to cover, we're going to talk about setting goals, budgeting, emergency cash reserves, insurance. How do we use credit? How they view you when they look at your credit, investing, tax planning, and retirement planning. So I want to talk about setting goals first, because that's one of the most important things as a financial advisor. We try to help all our clients do. We try to help them to prioritize their goals and to stay on track. So whether you're trying to eliminate your debt, or you're trying to purchase a car, or maybe you're looking at buying a new home, starting a business, funding for your kids' college education, or looking at retirement, setting your goals and sticking with them is very important. Unlike when we set our New Year's Eve resolutions, which most of us don't really stick to, they tend to, after a couple of months, we tend to do something else. We develop a little acronym called SMART, which is a way to help you stick with your goals. And that's being specific, having measurable goals, obtainable goals, relevant goals, and timely goals. So when we talk about being specific, if someone was to say that I wanted to save money for my child's college tuition, that's really kind of a vague goal. It's not really specific. So you could save $10 and say that I started saving for their education, but that's not the goal, right? You want to save more than that, hopefully, or you could save $1 million and maybe you're saving too much. So you want your goals to be specific. And an example of that may be, I want to save enough money to fund 4 years tuition for my children, whether they go to a UC school or a state school. You want your goals to be measurable. So when we talk about, let's say you want to retire early. Retiring early for some people is age 50, while retiring early for others may be age 60. So you want to look at saying, I would rather retire at age 55. That's my goal. So therefore, it's defined as well as there's an endpoint, 55. If we don't reach that goal of 55, as an advisor, we meet with our clients every year so we can make adjustments if there are life changes that come along. Because sometimes we do have to change our goals or modify them. You want your goals to be obtainable. I have a lot of clients say, Joe, listen, I have $5,000. I want to be a millionaire in the next 5 years. That's really not an attainable goal. That's not going to happen. But maybe you might want to say, I would love in the next 25 years to accumulate $1 million. I'd love to accumulate $1 million in the next 30 years. So therefore, you have a goal that's more attainable than sort of a wish list. You want your goals to be relevant. By relevant, I mean that they're specific to you. They're specific to your needs, your values, what you're trying to accomplish. Don't set your goals based on what somebody else is doing. They need to be specific to you. Also, goals should be timely. So if I want to pay off debt, I'm going to put a time limit on it. I'm going to pay off my debt within 2 years. So this is going to help you to prioritize your goals, and you definitely want to write them down. We want to talk about budgeting. Now, as a financial advisor, I like to tell people we want to construct a budget. Most people I know, they say, well, Joe, listen, I get my paycheck, I pay all my bills, so that's my budget. But that's not a real budget. That's not how corporate America budgets their revenue and expenses. They need to know when they're off track, when they're getting out of alignment, when they're spending too much. And that's the same situation for us on an individual basis. So you want to look at your income. You may have one source of income, which may be your paycheck. You may have other sources of income like rental income or Social Security or interest from CDs. And you want to tally up that income and you want to measure that against your expenses. We want to look at fixed expenses. Those are expenses that you're going to always have with you, like a mortgage or your utility bills. Those are things that you're going to have with you. Discretionary expenses are things that they're flexible. So you want to look at traveling. That's a flexible or discretionary expense. You want to talk about how much you want to spend for Christmas gifts. That's discretionary. It's not something that's going to be there every month, if you will. But what do I mean by really constructing a budget? When you look at your income overall, it should be divided up into percentages. And I didn't have my PowerPoint today, but I'd be more than happy to send it to people. So you want to make sure, for example, if you're looking at your housing expenses, someone who lives in Arkansas may be able to get away with 35% of their income going for housing, whereas in California, you may need more like 45 or 50%. If you're looking at debt, your credit card expenses should not be exceeding 5% of your income. So therefore, if your credit card bills, after you pay them, start to exceed 5%, then you know you're out of alignment. Maybe you need to cut back on some of your discretionary expenses. If someone is looking at purchasing a car and they feel that they can afford $300 a month, right? Did you include the maintenance and the upkeep in there? Did you include your car tax? Did you include your car insurance and gas? When you include all those things, maybe you can really only afford a $200 a month car note versus $300. When you're looking at your car expenses, they should be more like 8 to 11% of your income. It's a way of giving checks and balances to how you spend your money. Now, when we talk about risk management, we're mostly talking about various insurances. Most of you who are working, your health insurance, your disability insurance, and some life insurance comes through your job. The life insurance portion is not necessarily a permanent life insurance policy. That life insurance only exists while you work for that firm. once you leave that firm or retire, you no longer have that life insurance. So it's better if you have your own life insurance, so that whether you work for that company or choose to move to a different company, you always have something in place. Auto insurance, property insurance, liability insurance, these are some things that are covered through your agent. I want to spend a second talking about life insurance and long-term care insurance, because right now, long-term care insurance is a big deal. Many people are in what we call the sandwich generation. The sandwich generation means you're sending your kids to school or you're trying to fund for their college education. Meanwhile, you're trying to take care of your parents who may not have had long-term care insurance or don't have enough assets. At the same time, you're trying to fund for your retirement. So you're sandwiched in trying to fund for your kids and take care of your parents while also trying to prepare for yourself. That's a big task. Long-term care insurance is very important. And just because you have Medicare, that doesn't mean you have long-term care insurance. If you don't have long-term care insurance and you're caring for a family member or even yourself when you become of age, nursing costs can be as much as $9,000 a month. So it's better to provide yourself with some type of long-term care insurance. If you have parents who are, let's say, of an older age, maybe it's better if the siblings or the children get together and purchase a long-term care insurance plan for their parents. It's better to come up with a plan where you're splitting your bill for the long-term care insurance than to try to come up with $9,000 a month. Also, when I talk about life insurance, a lot of my younger clients, I start them off with life insurance. Why? They may not have all the responsibilities, but they're young in age and they're in good health. That means that your premium is going to be very low. So for someone graduating from college to purchase a $250,000 life policy may cost them $35 a month, versus as when you get older, you're going to have maybe some health issues that come about, or you have more responsibilities. There's kids, there's a spouse, there's a home to pay for. Now your premiums are going to be $300 a month because you're older. So it's better to get something while you're young. If not, you still can get some. It's just going to cost you more. Due to time, I'm going to skip the credit part. And I know that this slide's in Justin's presentation, but I want to reiterate it, that investing is not speculative. Investing is not a get-rich-quick thing overnight. It's not some kind of scheme, but investing is a carefully planned and prepared approach to managing money with the goal of accumulating funds that you'll need. You're going to have to think about wealth accumulation. That's what this is all about. And how your wealth accumulation is affected by various things. So when we talk about inflation, inflation has an impact on your wealth if you're not invested in the appropriate things. So for someone who has, let's say, 200,000 in our example, and inflation is running at an annual rate of 3%. And in case you don't know what inflation is, that means whatever you can purchase for $1 today is going to cost you more than $1 tomorrow. So if we look out 20 years with this inflation, it can only purchase $108,000 worth of goods. That means your $200,000 has lost about $92,000 of purchase power. If we look 40 years out, it's only worth $60,000 in purchasing power. Why do I bring this up? Because I specialize in dealing with retirement money. And if you have a need of $50,000 a year to support yourself in retirement, 20 years later, that need is now going to be $80,000. Can you afford $80,000 a year? And that's why we see some of our older generation, they were maybe invested in the wrong things, being ultra conservative, that their money did not keep up with inflation and taxes. So when you talk about investing, most of financial advisors are trying to make sure that your money is invested in items that keep up with inflation and taxes. I'm going to skip this as well. As a financial advisor, I went over a few things. We didn't really get into estate planning, but I'm going to touch on that a little later. Cash management, that's your budgeting. Risk management, that's insurance. Accumulation goals, that's your cash reserve. That's any personal investments. And retirement, that's your 401ks, your IRAs, any kind of pension plan that you may have. And as a financial advisor, we know what the left hand and the right hand is doing. So if you're making a major purchase, we want to know how that's going to affect your cash flow and your budgeting, as well as your accumulation goals. Now I have just 3 slides I really want to go to and spend a little moment on it. The first one is the rule of 72 and the rule of 115. And the rule of 72 states that whatever interest rate you're earning, if you divide it by 72, that's how long it takes for your money to double. If you divide that interest rate by 115, that's how long it takes for your money to triple. And this is what we mean by the importance of understanding that you have to take a little more risk with your money when you're investing, let's say for retirement, when you're trying to do long-term accumulations. I can't tell you how many people have come to me and said, Joe, I don't want to take any risks with my money. I don't want to lose any money. Well, let's take an example of that. If you put your money in the bank and it pays an interest rate of 1%, and most banks are less than 1% right now, if it pays an interest rate of 1%, you have to wait 72 years for your $100 to turn to $200. You have to wait 115 years for your $100 to turn to $300. Whereas if we move to a little more growth type of investing, which is in the stock market, which Justin will cover, let's say if you're averaging 9%. And if you look at that 9%, now it takes 8 years for your money to double. If you look at the rule of 115, it takes 12.8 years. So your money's tripling and doubling much faster. If you've been investing since Obama became president, when the stock market was at 8,000, and now it's at 35, 34, 35,000 the Dow, most people are averaging double digits. They're averaging 14, 15%. And if you look at that 15% column, you're averaging 4.8 years for your money to double and 7.7 years for it to triple. Here's another way I want you to look at this too. I always talk about the debt game and how you're going to lose in the debt game if you're constantly putting everything on credit cards and you're constantly accumulating debt. If you go to the bank, you give them your money and they pay you 1% for that money. Then they issue you a credit card. Macy's issues you a credit card. Best Buy issues you a credit card. And they're going to charge you 25, 26, 28, 29%. That's not even on my chart. But let's just assume that they charged you 20%. If they charge you 20%, then every 3.6 years, they're doubling their money off of the blouse you bought. Every 5.8 years, they're tripling their money off of the stereo that you purchased. I'm dating myself saying stereo. I don't think anybody even has a stereo anymore. But the point is, if you continue to accumulate debt and you're paying almost 30% for that money, you're going to dig yourself into a deeper hole. Everybody says they want to accumulate $1 million. Here you go. If you're wanting to accumulate $1 million, again, I'm going to encourage you to take a little more risk with your money, which Justin will talk about, versus being ultra conservative. So in this chart, we're going to look at the ultra conservative column first. If you had 40 years left to work, you would have to pay or contribute into your plan $1,362 a month in order to accumulate $1 million after 40 years. Or you can put in a lump sum of $450,000. But what if we moved over to the 8% column? If you had 40 years left to retire, you would only need to put away $286 a month, or a lump sum of $41,000. I can tell you right now, and I'm probably dating myself, when I got out of college, I was over at Fridays in the marina, and I was spending $286 a month. I think Fridays has my $1 million. But let's take an example here. If you only needed 25 years, right? And you're putting away for your retirement, in that 8% column, you would only need $1,000 per month, or $136,000 in a lump sum. But let's break that down even further. If you're putting away in a 401k and you're putting away $500 per check, that's $1,000. Maybe you don't have $500 per check to contribute. Maybe you have $300 per check. That's $600. If your company's matching you, and maybe that's adding an extra $100 a check, now you're up to $400 per check. So you see, it's an accumulation thing. When you're talking about investing, it's always about accumulating wealth. If you couldn't do $1 million, but maybe you could do $500,000, now you're cutting that $1,000 in half. It's $500 total. If you wanted to accumulate $250,000, it would be a fourth of that. It would be $250 total. The last thing I want to leave you with is that in this slide, it says meet the estate planning team. And it's talking about having an attorney, a CPA or a tax professional, an insurance professional, trust administrator, charitable trust advisor if you want to give something to your favorite charity, and also a financial professional. I can tell you, you need that team, not just for estate planning, you need that team for wealth accumulation. I love working with an entire team. You're not going to always be able to see the attorney because they work on billable hours, but you should be seeing a financial professional at least once, maybe twice a year, to help give you advice, to tell you that if you're purchasing something that may interrupt your cash flow, then maybe you need to talk to the tax professional. Or if you're taking items in and out of your estate, or maybe you had another child, that's going to affect your trust. So I'm going to advise you, maybe you need to amend your trust. We're going to always lead you back to a member of the team. So just think of it this way. Everybody here on that team has your best interest at heart. My name is Joe Haywood, and I hope this has been helpful. Thank you for your time.
Thank you, Joe, for that insightful and informative presentation. Now we're going to go to our next presenter, who is Justin B Lacey. Justin is Vice President, Resident Director, and Wealth Management Advisor. Justin graduated magna cum laude from the University of Southern California. We got a lot of USC people with us tonight, where he was a double major in business administration and accounting. Justin is a member of the B of A Black Executive Leadership Team and the Merrill Lynch Black African American Leadership Council. He holds designations as a certified financial planner, a certified public accountant, a certified private wealth advisor, and accredited wealth management advisor. This is a bad man, as Stephen A would say. Justin, welcome to BWAR.
Thank you, Reverend Smith. If I can get a thumbs up from you to make sure that I'm coming in, you can hear me. Perfect. All right, everyone. Reverend Smith, thank you for having me here. Jacinda, thanks for putting this together. Everyone at LA Urban League and Parkside, it's an honor to be here with you. I love talking to individuals about financial planning and investment management and just, helping inspire and educate on what more we all can be doing to better improve financially, right? A lot of times it's a lot more complicated than it really is. And a lot of times folks just need an individual like myself or Joe to just break things in the basics and help them by educating them so they can be able to create that discipline, so they can be able to accomplish all their goals and get to where they want to be. And I love the fact that I'm a part of that puzzle. Joe, phenomenal job as always. You killed it. Loved all the comments on the financial planning, I know you didn't touch on credit, but that's important. Estate planning, right? Insurance. People think about the road to financial success, and they think about the role of a financial advisor and helping them out in that road to financial success. And a lot of times they limit it to just investments, right? And I'm going to cover investments, right? So I'm going to go over that. And investments is extremely important. But I want to emphasize the point that the road to financial success is a whole lot more than just investment success and the right investment portfolio. It's really about that advice beyond investing as well, right? I come from a background where, my parents had a good financial advisor. They were getting returns that are outpacing their benchmarks, right? But then a health event took place where they didn't have disability insurance, right? They didn't have a long-term care policy for my grandma that was in the long-term care facility for 10 years, right? I had to pay out of pocket for that, right? They didn't sock away enough money before they were, while they were making good money to be able to create that nest egg to fall back on, right? So that advice beyond investing and that cash flow and retirement planning, all those things that Joe mentioned for financial planning basics, that is just as important, if not more important, to the puzzle of financial success than having a great investment portfolio. But at BWAR, right, we try to maximize everything. So we're going to get you right in terms of the overall financial planning, and we're going to get you right in terms of the investment management and investment planning piece. And as Reverend Gerald mentioned, I'm going to cover the investment basics. So let's get into this. I'm going to share my screen, hopefully to some success. Once again, Reverend Smith, can you give me a thumbs up if you can see that? All right, cool. We're in it. So as Joe mentioned, Joe brought up this great slide before on inflation and how $200,000 today is like $100,000 in 20 years and $50,000 in 40 years, right? So people think about investments, right? And kind of as Joe alluded to, they think of like, hey, if I put money in the market, right, I'm taking a risk, right? And yeah, you're taking a risk because the market has volatility, right? It could be up one day and down another day, right? But over time, it's shown that investing and staying in the market has worked out well for individuals that have done so, right? Since 1926, when the stock market kind of came into place, the probability of you putting money in the market and it being higher one day afterwards is about 50%. And that's what Joe was mentioning. That's speculation, right? That's almost the same odds as going to Vegas and putting money on black at the roulette table, right? 50% odds, roulette X actually 49%. I know that because I gamble too much, but that's the idea. That's speculation, right? However, if you put that money in, historically since 1926, if you put that money in the market for 1 year, the probability of it being higher 1 year later is 75%, okay? You put that money in the market for 10 years, probability is higher, has been over 95%. And you put that money in one day, the probability that the money is higher 20 years from now has been over 100%. There's never been a period in time since the stock market's been open and since 1926 that you put money in and 20 years later it was lower, right? So the longer that your time horizon is, the higher the probability that you're going to make money, right? So I don't consider that as risky as that field that page that Joe showed, where purchasing power is getting lower and lower each year. If you're keeping money in cash, you're not earning any money, which means it doesn't feel like you're losing money. But best believe, if you have $200,000 in your bank account today and $200,000 in the bank account a year from now, you've lost money because you're not going to be able to purchase the same amount of things as you did before. So it's super important to be able to start putting money to work and investing. And as this slide shows, investing fundamentals, the sooner the better, right? People try to ask me all the time, like, when should I put money in the market? I'm scared about, these openings of this, the vaccine rollout and people not doing boosters and all that stuff. If I could tell you that in 2020, in January 1st, 2020, no one had any idea that there was going to be a pandemic on the way. The market was up a little bit in February, and then a massive pandemic took the world by storm. And at the end of that year, the stock market is still up by 18.4%. You'd be like, slap me, so that's no way that happened, right? That happened, right? No one can predict the direction of the stock market in any given year. So trying to guess when you should get in or when you should get out, it's a loser's game, right? So the best approach is that when you have money that can stay invested for a number of years, you throw it in the market. And this is kind of what this is detailing that. This slide is detailing that. Basically just showing that if you put, $3,000 a year in the market beginning at age 20, 45 years later, you're at $679,500. If you started 20 years after that instead, it's only $254,000. If you started like 20 years after that, it's only $120,000, right? So the earlier you put more money in, the easier it is to be able to accumulate a nest egg for you to be able to retire and accomplish all your financial goals. Now, how do you come about thinking about an asset allocation, right? An asset allocation, right, is I'm going to invest, right? What percentage should be in this bucket? What percentage should be in this bucket? What percentage should be in that bucket, right? So to come to an understanding of that, you should work with someone like a Joe Hayward or a Justin Lacey or another trusted financial planner and advisor, and really think about these factors, because these factors should determine how you invest your money, right? One is personal financial situation and goals, right? So, if you're, someone that's looking to retire, at age 63 and spend, $1 million and wants to get a kid through college that starts in that's going to become 18 in 5 years, they're going to have a different financial situation and goals and needs for appreciation and needs for timing than someone that's looking to retire 50 years old and doesn't have any kids, right? So understanding your own personal situation, your own financial goals is going to determine what asset allocation makes sense for you. Risk tolerance, right? Someone needs to help you understand how much volatility you can take, right? So if you know that, hey, I know investing in the long game is going to work out for you, but it just pains you to see your portfolio $1 less than it was yesterday, then you're not going to be able to invest as, risky or as aggressive as someone that understands that volatility is the name of the game. And if their portfolio is down by 20,000 one day, they don't see that as a concern. They see that as a buying opportunity where they say, shoot, stocks are on discount now. Let's actually go in there and buy at discount, right? So you have to know yourself and understand your tolerance to be able to see ups and downs in your portfolio. That's going to determine how you invest your money. Time frames, right? As I mentioned before, based on those statistics on 1 year, 5 year, 30, 20-year returns, the longer that money is able to work for you, the more aggressive you can be in your investments. Liquidity needs, basically just how quickly you need this money to convert to cash to you, right? How quickly do you need this money back, right? If you can keep the money, you don't need to convert immediately, you can take aggressive investments. You can do investments that maybe take longer to unwind, like alternative investments and things of that sort, right? But if you have a very, very high liquidity need where you need cash immediately, you're going to be in things where they can convert to cash very easily and may not be as aggressive. And then lastly, diversification. This shows an image of eggs in a basket. It goes to the whole mantra of you're not trying to put all your eggs in one basket. Ideally, you want to work with someone that can help you figure out, hey, how can I put eggs in this basket, which has shown the ability to have high returns, this basket, this basket, this basket. And ideally, you want to be in a situation where all those baskets are increasing in value over time, but in any given year, one is zigging and one is zagging, right? So you want something where, hey, one basket is down by 5% this year, but I have another basket that's up by 6% this year, right? So overall, I'm up 1%, right? So you want to be in a situation where you have different types of assets that perform differently in any given year, because that's going to smooth out the returns that you have over time and make it a little bit more manageable for you, right? So I'm going to cover, kind of top level types of investments through this presentation. So I'm going to cover cash alternatives, bonds, stocks, funds, alternative investments, right? So we're going to get into some of those details. Now, I don't want to get you confused. I'm going to be covering types of assets you can invest in, right? What I'm not going to be covering is different vehicles you can have to invest those assets, right? So a 401k, an IRA, a brokerage account, those are vehicles that can own these assets that we're covering. So I want to make sure that we understand the distinction. And if you need help getting advice on, hey, what vehicles can I qualify for that make the most sense tax efficiently for me based on my situation and my employment, that's a conversation you have with the Joe Hayward or myself, because we can help direct you and what are the vehicles that make the most sense in owning the assets that make sense for your allocation. Okay, so we'll start first with cash alternatives, right? So these are things like, this is cash at your bank that's earning absolutely nothing, earning absolutely no interest. These are certificate of deposits or CDs, money market accounts, right? Treasury bills, but basically these are low risk items that are not getting a ton of return. As Joe mentioned before, you're not going to find a cash return that's earning you probably more than 1%. Most of the CDs and money markets I'm seeing are earning like 0.05%, right? So this is something where you just keep your money safe and you have it for short-term needs, or you have it as a place where say, hey, once my financial advisor tells me this is an opportunity to invest in this fund, right? Maybe if this fund drops by 20% or 10%, but it's a great fund that's going to have a great, overall return, that's when we're going to take this money from our cash alternatives and throw it into that investment, right? So it's something that is to keep your money safe, earn a little bit of interest, but also potentially be a source of funds to invest in areas where opportunities present themselves, right? So advantages, predictable earnings, high liquid, and as I mentioned, disadvantages, low returns, and may not keep up with inflation, right? So let's move on to bonds. So bonds are, when you're a bond holder, you are a owner of a company or municipality's debt, right? They have an IOU for you, right? So, it could be a circumstance where Apple says we want to build a new plant. We're not trying to give out ownership of Apple. We want to keep our owners where they have, but we need, $50 million to make this happen. So we're going to have a whole bunch of investors give us $50 million. We're going to write them checks of interest each 6 months. And then over 10 years, 15 years, we're going to give that entire $50 million back and be done with it, right? So these tend to be, not as risky as like stocks where you're owning an actual company. You are a debt holder for the company. So interest typically paid on a regular interval, typically about every 6 months. They can be traded on the market, and the values do fluctuate, but not to the extent of stocks typically. Advantages, steady and predictable stream of income, typically higher returns than cash alternatives, and as I mentioned before, relatively lower risk compared to stock options, to stocks. And from a disadvantage, so the biggest risk of being a debt holder is that the company goes out of business. Because the company goes out of business, they may not be able to give you back the money that you lent out to them. So if you are going to buy bonds of like an Apple company or of a company out there, or a municipality like this, California Water, right? You just want to make sure that, hey, am I getting enough interest for the amount of risk that I'm taking? And two, do I have conviction that they're going to still be around and be able to pay me back my principal that I lend them when that term is up? Right, moving on to stocks. So for stocks, instead of being a debt holder to a company or for a municipality, you are a owner of a company, right? So you have ownership over that company. So using that Apple, example, you now become an Apple owner, right? So if Apple reports that, hey, we thought we were going to sell 100 million iPhones, we ended up selling only 75 million iPhones, the stock price may take a hit because you're a partial owner. And now people are thinking, hey, Apple may not be on this up and up trajectory that we thought that they were before. So the value of the stock should probably take a dip because it's probably not worth as much as we thought it is. So when you own a stock, headline news and what's happening to that company, it's going to very much dictate the direction of the stock, and the moves of the stock up and down are going to be a lot more aggressive usually than a respective bond ownership of that company. The advantages, provided, long-term returns. We talked about the returns over 1, 10, 20-year periods. You have ownership over the company, which means you can actually do proxy and do votes, right? So when Apple is deciding to make a change at the top of leadership, if you're an owner of Apple and have 5 shares, you have 5 votes towards what they should be doing or what they shouldn't be doing. It can provide income. Some stocks provide dividends. So basically they kind of write you checks on a quarterly basis that you can either buy more the stock with or take out in cash. Also an appreciation, potential for the appreciation of that stock as well. And they're very easy to buy and sell. So many, discount brokerages out there, like, all of them out there from like Robinhood and E-Trade, Merrill Edge, all that stuff. You can easily buy and sell stocks yourself at the click of a finger using your mobile phone. Disadvantages, as I mentioned, if there's a poor performance for the company, it's going to take a hit. And there's typically a lot more a lot more volatility or ups and downs with stocks, and a greater risk to your principal when you invest in it. And as it shows on here, it may not be appropriate for the short term. All right. So those are stocks, bonds, and cash are like the 3 major asset classes, right? Mutual funds can actually, so there's actually stock and bond mutual funds. A mutual fund, and let's use stocks for an example, a stock mutual fund is just an aggregation of a whole bunch of stocks, right? So you can have a Vanguard S&P 500 mutual fund. That's all you see on your statement. That's all you know that you know. But if you actually drilled into it and I kind of read into the prospectus, you'd see that it actually owns like 100 or 200 companies out there. But all you see on your statement is one mutual fund. So it just aggregates a whole bunch of stocks in one position. Advantages, diversification, right? Instead of just investing in one stock like Apple, you're investing in a whole bunch of stocks, right? Which is helpful because you have more eggs in different baskets. A mutual fund manager is going to professionally manage that. So a mutual fund manager is, for the most part, are going to be actively managed where they're trying to outperform the return of a benchmark, right? So, but if there's a mutual fund whose benchmark is the 500 biggest companies in the United States, that mutual fund manager may say, you know what, we're really smart and savvy. Instead of us owning the 500 stocks that are part of this benchmark, we're just going to pick just 50 of them. And we think the 50 we're going to pick are going to outperform the 500 in the benchmark, right? So they're professionally managed, actively managed, trying to outperform a benchmark. So you can typically get in there with small investments or liquid. And disadvantages of them is that they're obviously shares can fluctuate as any type of stock position has on there. They potentially can have some tax inefficiency, and they typically are more expensive than ETFs, which we're about to cover now, as well as owning individual stocks, because once again there's a professional manager that is managing this mutual fund, as I mentioned, and doing all this research and trades, trying to outperform that benchmark. And with all that work that goes into it, they need to charge fees to commensurate themselves for all that work that they're doing. Okay, ETFs are once again a pooled investment, just like a mutual fund, but most ETFs are what we call passively managed. So using that same example under the mutual fund, an ETF manager that has the 500 largest US companies as their benchmark, they're not going to just try to choose 50 stocks like the mutual fund manager and try to outperform it. They're just going to say, okay, if our benchmark is the 500 biggest US stocks, we're going to pick the same 500 stocks as them, right? So an ETF manager is not trying to outperform a benchmark. They're just trying to replicate that benchmark performance, which means the fees are typically lower, and there's a low likelihood that it grossly outperforms a benchmark and does like miraculous, but there's also a very low probability that it does really bad and underperforms the benchmark, because it's basically just trying to get that same return that that benchmark is doing. So once again, it's based on the index. They typically have lower fund costs as opposed to a mutual fund. And the benefit of an ETF is that it can be traded throughout the day. So a mutual fund manager, for a mutual fund, if the market opens up at 6:30 a.m. Pacific time, closes at 1 p.m. Pacific time. So if you decide at 7 a.m. that, hey, I want to sell this mutual fund, right? You can put that order in at 7 a.m., but you don't sell that mutual fund until the market closes at 1 p.m. Pacific time. right? That there's a lag. So basically the fund manager has to redeem your shares at the end of the day. For an ETF and for a stock is what if you own outright stock, if you decide at 7 a.m. you want to sell Google and be out, you can be out at the 7 a.m. price of Google. And for an ETF, if you own an ETF and it's priced at $30 at 7 a.m., you can sell that ETF at 7 a.m. and be out at that cost, at that price. So that's the benefit of it being traded in and out the day, and not to wait until to be redeemed at the 1 p.m. Pacific time. And typically they are more tax efficient. So typically ETFs are better to be held in a non-retirement account where you're taxed on ups and downs and redemptions, as opposed to mutual funds, which seem to be more tax inefficient, which a lot of financial advisors tend to put those mutual funds in vehicles like IRAs or 401ks, because that tax inefficiency doesn't hurt you because they're retirement accounts. Okay, and then now I'll touch on other investments. As I mentioned, the big classes out there, right, are once again cash, stocks, and bonds, right? And then mutual funds and ETFs can own, stocks and bonds as well, right? So other investments I'll quickly touch upon, right, to build out this whole, scope on having a diversified asset allocation. You got real estate, right? So, we're in Southern California. If you bought your home in Southern California, guess what? That's probably a great investment decision. Your real estate price is probably much higher than what you purchased it at. That is a part of your portfolio, right? So don't think that, oh, I just have a home and a 401k, I don't have any assets. Nah, forget that. If you own real estate, you own an asset class. You have that, right? 401k is an asset class, right? So consider that as a part of your investment portfolio. That could be your primary real estate. That could also be an investment property that you buy as well. Alternatives, right? So, funds, financial advisors can offer things like private equity, where you can invest in companies that aren't public yet, but that may become public at some point. You kind of get in before they take off. That could be a great investment option. Hedge funds, where hedge fund managers typically, there's some hedge fund managers where they are, long some stocks where they think that they're going to perform well, so they invest in them, but they also think that there's some stocks in the market that are not going to perform well, so they invest in them. So in a downward market, some hedge fund managers can actually provide a positive return because maybe they are, less bullish on certain stocks that are getting beat down, and actually provide you with a return in that negative return environment. So that could be a potential option to put funds. And then private real estate, where basically you can have like a big company that manages a whole bunch of private real estate. You can put money with them and they'll buy real estate for you, right? And that allows you not to worry about, having a property manager or having risk and having to visit your property and stuff like that. Now for alternatives, there usually is an investment minimum. You typically can't get in unless you make over like $200,000 a year and have a certain amount of assets, but that can be something that you may want to consider at some point in time. Moving down, you have futures and commodities, which is basically, speculating the future price of like certain goods and like common commodities, like corn and oil and stuff like that. You have collectibles, right? You have digital assets, which is a big thing now. So digital assets, that's Bitcoin, that's NFTs, right? That can be a part of an investment portfolio. You have annuities on there. So, annuities, life insurance, which I'll quickly touch upon because, what I find, especially in the African-American community, is that a lot of times our wealth is in real estate, it's in life insurance, and it's in annuities. And, there's no knock on any of them, but I would say that I usually don't recommend annuities or life insurance to be, the whole piece of your investment portfolio. It could be a good complement to what you also have, but it probably should not be the whole piece, right? An annuity, there's some annuities that provide you with the ability to have appreciation, to have growth in that investment and have some downside protection, which is attractive. There's also some annuities that provide you with a guaranteed income, which is very attractive as well. But with annuities, that money can be locked up between, 5 and 7 years, and you get penalized if you touch those funds beforehand, right? So, with that kind of illiquidity with annuities, as well as some other things that I would go into in this one call, you may want to consider that being a piece of the asset allocation for you, but not the whole pizza, right? And then for life insurance, you talk to some life insurance providers, and they talk about life insurance like it was the best thing God invented since sliced bread. Life insurance can be a good solution, right? And it can be attractive as a vehicle to create cash value and have an investment tilt to it as well. But once again, it's not something you have immediate access in. You really want it to be able to grow and kind of stay within that life insurance vessel as long as it possibly can. So it can be a potential solution, but it should also be a part of your asset allocation with, you know, all the other investments that we've covered today. And then the last slide in terms of, you know, role of a financial professional is, we help, the biggest role that I think we offer is helping people identify their goals, helping them really understand, hey, what am I really trying to accomplish short-term and long-term? And then building a financial plan that they can follow, right? Because if you built that financial plan and that financial plan has all your goals on there, and it also has the investment allocation that you need to be successful in reaching that goal, it helps out so much just from an emotional standpoint, right? When the market was down by 35% in 2020, March 2020, and I had clients that were concerned about their investments and what was happening, the first thing I did was went to that financial plan, right? And before that 35% drop, that financial plan said that they had an over 90% chance of success if they just stayed the course and kept their investments as they were. And when we looked at that plan again, after the investment down by 35%, it still showed they had an over 90% chance of accomplishing the goal as long as they stayed the course and didn't react to the news and react to the market. And, that was just amazing, just peace of mind that I provided them, right? And the fact that the market roared afterwards, right, and was up 18.4% at the end of the year, it was thank yous. It was thank you for providing that perspective. Thank you for keeping me in there, right? So that's really the biggest value, is that we're going to help you establish a plan and talk you through and revisit that plan when there's volatility to make sure you stay the course and that you do all that you need to do to accomplish your goals. And the last thing I'll say about, volatility and investing in the market is that it is scary, especially when you watch like CNBC and CNN. They say, oh, the Dow or the S&P is down by 20%, and it can seem pretty nervous and shocking. I just want you to know that Peter Lynch once said, Peter Lynch was like a famed investor, and he said the quote that far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves, right? So and just what that kind of highlights that so much more money is lost, and people are just keeping money in cash and being too concerned to put it to work and invest than if they actually invest that money and had that temporary blemish, right? Because market volatility is to be expected, not to be feared. And if you work with a financial advisor, or you have that financial advisor on speed dial, they'll be able to help you, stay the course and avoid the costly emotional decisions that any of us could be susceptible of having. And I'm a financial planner myself, and I recognize the value of investment allocation, the course, all that stuff. But I myself have a financial advisor that helps me out because I know I get emotional. Just because you know this and you're savvy and all that stuff does not mean that another set of professional, unbiased advice and words could not be instrumental to your success and your support. So that's all I have. I can kick it back to you, Reverend Gerald, or Jacinda.
Hello, everyone. My name is Jacinda Moten. I am the virtual producer for today's session. Joe and Justin, you all did a wonderful job on your presentations, and we will now begin the Q&A portion of the program. So if you all have a question, please post your question in the chat, and we will address them one by one. And I will double spotlight Joe and Justin. Or you can put your questions in the Q&A prompt. Okay, question from Shannon Aldoff. What are your thoughts on investing in gold?
Yeah, I can cover that. It's a great question. So gold is a asset class that provides no dividends or interest. So there's no income when you invest in gold. You're basically, speculating or expecting that just the price of gold is going to increase over time. Gold typically, has a somewhat inverse correlation to the market, which means that, hey, if the market is down, there's a greater than 50% chance that the value of gold is up. right? So like I remember they interviewed stockbrokers after the 9/11 crashes, and they asked them, what was the first thought that you had when you saw the plane go into the World Trade Center? And the answer was to buy gold, right? So it's the safe haven and the place where people go when they feel like the economy or the market or just the world is about to go south. So it can be a great diversifier and something that you have allocation to, which may be able to help in terms of that zigzag where, if your stocks are going down, maybe a gold position is going up, which is balancing that and keeping your portfolio in line with your risk tolerance. So it is something to be considered. May not be for everyone, but it is something that you can consider. And then the types of ways to own gold, you typically need probably at least like $50,000, $100,000 to be able to actually own actual gold and have it stored somewhere. So what a lot of people do is if they're trying to get exposure to gold, they'll buy a gold ETF or mutual fund, which have a lot lower minimums that provide similar exposure and similar returns than owning the actual gold itself.
Great info. Next question is, what are your thoughts on cryptocurrency? What are your sites for holding crypto?
Joe, you want to take that?
Yeah, with regards to cryptocurrency, there's a lot of different opinions out there. Obviously Bitcoin is now above 57,000 for the coin. I more or less specialize with retirees. And since when you have Bitcoin, you don't really own an asset. It's something that is a cryptocurrency. And so I usually tell clients if they want to, they could buy one of the trading vehicles like Coinbase or something like that. But for my clients, I usually tell them, if you don't own anything and somebody can take your cryptocurrency off the stock market, out of your account, or if you lose your account information, then you have no access to it. It's kind of hard for me to put a lot of their retirement money there. If it's something that, it's a personal investment, then yeah, you can put a small percentage there. Most advisors, they might be putting maybe 1-2% of a person's portfolio in there. I'm still not comfortable yet for retirees.
Okay. Our next question is, what are the available options for investing directly in Black-owned businesses?
Go ahead, Justin.
I was hoping you were going to start.
Oh, well, no, there's a lot of Black-owned companies in the stock market, so there's actually something called I want to say it's called the Black Wall Street pages or something. I'll have to remember the name of it, and I'll get it to your guest. But also there are investment companies that are Black-owned. Like the Ariel Fund is a small cap investor. It's a Black-owned firm out of DC. It's won all kind of awards for their investment, and they've done a great job. There's a lot of Black fund managers in the industry that have done extremely well. But there are Black-owned companies, and I know that we just had a merger with United Bank, one of the Black-owned banks. We would hope that we have more banks that are Black-owned, because that's a good asset class to have. But yeah, there are a number of Black-owned companies, and I can also get you a list of that as well. Joe
covered in terms of investing, you can invest directly into a mutual fund that's Black-owned, like the area that he mentioned. You can invest in publicly traded companies that are Black-owned, right? And also, a lot of, if you're in the community, right? You may be approached by a Black individual, Black company that's looking for investors and looking to, grow or do something like that as well. And that could be a consideration, obviously. And the way that a financial planner can help provide consultation is that I have clients all the time that say, you know what, I was approached to invest in this opportunity. What does my financial plan look like if I invest $10,000 here and it turns to $50,000? But I also want to see what if I invest $10,000 here and turns to zero, right? So getting that consultation to make sure that, hey, I want to invest directly in this Black-owned company, right, wherever it is, right? Getting that confirmation that, hey, if you invest into it and it ends up not working out, you're not handicapping yourself in terms of your financial goals. That could be a very important and helpful exercise to have with a professional.
Nice. Next question we have. What advice do you have for an older adult with no knowledge of the market, but who wants to invest in the stock market? I think, Joe, that would be for you.
Well, my advice would always be for an older person to look at doing a mutual fund. It has a low entry point versus if you're trying to buy stock, and if you're trying to buy, accumulate 100 shares of Apple, 100 shares of Disney, 100 shares of Coca-Cola. It depends on how much money you have, but usually a mutual fund, you can start a mutual fund with $50 a month. Some of them have an entry where you pay $250 and then you can add to it. So I saw someone on the attendees list that's with the Capital Group, American Funds. American Funds is one of the largest mutual fund companies in the world. They're based here out of California. And one of their flagship mutual funds is called the Growth Fund of America. Growth Fund of America's averaged, I think, like 13% since 1973. So they invest in large growth companies. So when we say, when you hear Justin and I talk about large companies, those are companies that do $10 billion in revenue or more. If it's a small company, maybe they do 300 million to 2 billion. A mid-sized company does 2 billion to 10 billion. So when I say a large company, I'm talking about Northrop Grumman, Coca-Cola, Disney. So you're putting your money with big companies that you've probably heard of almost all of them. And those companies more than likely are paying dividends as well. Smaller companies, you probably may not have heard of all of them. You may have heard of Domino's Pizza, somebody like that. A mid-sized company will be, Goodyear or CarMax. Those are mid-sized companies.
Yeah, and then I would just add, have an understanding of what you want to invest in based off of your risk tolerance, right? Like Joe mentioned, figure out the positions that make sense for you to own. And if it's your first time and you're super nervous, and what I'd probably recommend is you dollar cost average into that. And what that means is, if you know that you're going to invest, $100,000, it's your first time really doing it, and you understand the investments you want to choose with $100,000, don't do it all day one, right? Invest $10,000 a month for the next 10 months, right? For an example. And that way, it's going to ease you into it, right? So you put that first $10,000 in, the stock market starts going up, you'll think, hey, at least I started putting some money in and I got some growth, that's fine, right? You put that first $10,000 in, the market goes down and the value drops, you're saying, hey, at least only put $10,000, $100,000 I'm going to put into it. And now my next $10,000 is actually going to buy me more shares, and by that discount, you're going to feel good about that as well. So that kind of helps you from an emotional standpoint, put that money to work.
And I might just say one other thing, Jacinda, that, it depends on how old the person is, but today, a lot of older people got a raise today because Social Security increased by 5.9% cost of living raise. So those who were collecting Social Security, you received a raise today.
Our next question is, for a new college graduate, should they invest in a regular 401k or IRA or the Roth option? What percentage breakdown between the two choices?
Could you repeat it again, Jacinda?
For a new college graduate, should they invest in a regular 401k or IRA or the Roth option? What percentage breakdown between the two choices?
Well, for a new college grad, it depends on if they're working for a company or they're working for themselves. If you're working for a company, you're participating in a 401k. Now, a lot of companies also offer a Roth 401k. There's no real income restrictions, so you can contribute. The 19, I think it's 19 up to 19,500. If you are a younger person, if you have if you're paying a lot in taxes, you may want to contribute part of your money in a regular 401k. But I also would suggest really accumulating a lot of money in your Roth 401k. So you may, from a percentage basis, if you have a tax issue, maybe you're doing, let's say if someone's contributing 10% into their plan, maybe they're doing 6% in the 401k and 4% in the Roth. And for those who don't know the difference, a regular 401k, all of your money is pre-taxed. It hasn't been taxed by Uncle Sam yet. So it accumulates for you on your behalf, whatever you're investing in. And then when you are ready to pull that money out, let's say once you retire, it's all taxable income. But a Roth 401k, it's an after-tax contribution. And all of the money that you put in there is going to grow for you tax-free. And when you pull it out, it's tax-free. So it definitely has a huge advantage later on.
Definitely. Next question is, what are some assets that produces an 8% return?
You want me to keep going? Well, let's just put it like this. The S&P 500 does more than 8%. The problem is the average investor does like maybe 5 to 6%. And the reason, this is another reason why you need a financial advisor, and Justin really tapped on it. The average investor gets emotional and gets in and out of the market at the wrong time. If you miss just one good day in the market, it reduces your returns significantly. So the reason the average investor is only making 5% rate of return is because they're, oh, when the market goes down, I'm out. I'll wait till the market gets good. Well, by the time the market comes back and the market's good, you've missed all the uprise, right? So think of Warren Buffett, who's one of the most successful investors around. I mean, one share of his Berkshire Hathaway stock is out of the ballpark for a lot of us, right? When the market goes down, that means stocks are on sale. Just like you look for a sale in a clothing store or appliance store or an equipment store, whatever it is, when Justin was talking about last year, American Airlines went down, cruise industries went down, a lot of people went down. But when the market returned, wow, if you'd have bought them when they went down, they had a great return for you. So don't try to time the market. If you stick with your program, like I said, most of your investments, most of your growth mutual funds, most of the portfolio with the fund managers, like we would use an independent fund manager, not a mutual fund manager, but a money manager, they all do really well. But if you're looking for something overnight, that's where the problem comes in. I can't tell you how many people think that I'm supposed to find something and they're going to make 30% overnight.
Mm-hmm. Gotta take your time.
Yeah. So as Joe mentioned, stocks historically returned about 10% annually, but you can expect a 10% return in any given year. That 10% is made up of plus 30%, plus 40%, plus 20%, minus 20%, minus 30%, right? So you have to just stay in the game And those stocks have been one of those asset classes that have returned over that 8%. You can't predict that 8% return in any given year. You really have to allow it to play out for multiple years to be able to see evidence of that type of return.
One of the attendees, they really want to keep up with you guys. So do you guys have a social media handle for them to follow you on?
Haywood Associates is my website. I can always send them my newsletter and everything else. They can contact me. Just go to www.haywoodassociates.com. And I do other seminars. I speak at churches. I do a lot of things. So.
Yeah, I don't have a social media based on financial planning, unfortunately. That's a millennial thing. That's why Joe Hayward got it, not me. So follow Joe.
All righty. Next question is, do you have an opinion on purchasing stock in the Lucid Car Company, the new to come electric car?
So me and Joe, we're unable to give investment advice in one of these things, right? So, but if you have questions on a specific stock, I can follow up with you, and if we follow it at Merrill Lynch and have a report on it with like a price a price expectation and some details, I can send that over to you. But it's gonna have all my little disclaimers and all that stuff as well. So you can follow me offline for that.
Okay.
It's a beautiful car. I could say that much. I love the car. A lot of people are looking at purchasing companies that deal with making the batteries for a lot of these cars. They think that's an up and coming market. And you can see there's a lot of firms that, with this shortage of the microchip now, people are really looking at why is the United States being held hostage with regards to that. Maybe there'll be more companies producing microchips. So just look at it like this. Whether the market is up or down, Wall Street always sees an opportunity. Wall Street is not emotional at all. So if a hurricane hits a town and the town is wiped out, Wall Street's like, so what do we buy? Do we buy Home Depot? We buy this insurance company? They're not emotional. They're looking at what's going to make sense for the client, what's going to make them money.
All righty. Our next question is, Joe, in general, what are your thoughts on taking Social Security early at 62 or waiting until your full retirement age?
That's a loaded question, and that depends on the individual client, depends on if they're married or not. So for example, a lot of people don't understand that, let's say, for example, there's a difference in age. Let's say and I'm just, not being stereotyping anybody, but let's say the man is, let's say 5-6 years older than the woman, right? If you wait till full retirement age, and those of you who were born 1960 or later, that's age 67. For those of you born in 54 and all these other years, it's going to be like 66 and 3 months, 66 and 8 months. But if I'm still working at and I'm close to full retirement age, I might want to stay working, because you can work at full retirement age and collect your Social Security. So now you're getting your work income and Social Security. And if your spouse is 62 years of age, she can get a spousal benefit even if she's working or not. So now you just increased a number of your revenue streams. So it might help you pay off your house or get out of debt. It starts about maybe like at 35%, if she's 62. But if you're single, just remember this. If you take it at 62, you cannot make, if you decide to go back to work, whether it's part-time or whatever, you can't make over $17,000 in a year. Because if you do, for every $2 you make above that, they're going to take away $1 of your Social Security. So if you're taking it early, you want to make sure you're not going back to work. But it's an individual thing. You need to run the numbers and show people, you know. But you definitely want to think about if you're married, you have more things to consider than if you're single. Let's put it like that.
Good advice. Our next question is, this person has a master in secondary education looking to try to get an IRA or a CD. So they would like, which is the better option for the career that they have?
You want to get an IRA because you want your money to grow for you. CD rates are very low. It's not that CD rates can't go up, but you know, you're locking them in for short periods of time. So that's not necessarily, I don't look at CDs as a retirement vehicle. I look at them as a cash reserve vehicle, you know. So gone are the days when your parents had those savings passbooks and the banks always paid a minimum of 5%. We haven't seen 5% passbook rates in a long time. So you know, you want to look at other alternatives, and an IRA gives you more things to invest in that will grow for you in the long term.
Yeah, and if you're under the income threshold, a Roth IRA may be a better solution than a regular IRA. So just, you know, talk to someone about that and what those thresholds are, because that may be something you want to look into.
Okay. Question: how important is ESG investing for the future of the Black community?
You want to take that, Justin? The sustainable funds?
Yeah, I mean, I'll start and then you can follow up. And ESG, I mean, so ESG it's so broad now. It covers so many areas, right? From society to diversity and inclusion to nature to governance. Like it's so vast. So one thing is like, do your research, right? I mean, there's ESG mutual funds out there, right? Where you may put some money in there, you feel like you're helping out the Black community. None of those dollars may circulate to anything that's Black related, right? So you really got to do the research and understand what the mission statement is for the ESG fund that you're investing in. But I do think there's a lot of opportunities with ESG funds. It is becoming a mandate for a lot of corporations. So a lot of corporations and municipalities have big investment portfolios, right? And they use portfolio managers like that. And they have a board that tells them and advises them on how they should invest their money. And the amount of these companies and municipalities that now have mandates to invest a percentage of their money in ESG and governance and those type of funds is growing exponentially. So I do think there is a lot of opportunities and promise in investing in ESG. Just make sure that the ESG that you're investing in, one, has a great runway and prospects for advancement and appreciation, and two, it's speaking and contributing to the ESG area that you want to make an impact in.
All righty. Is there any more questions in front?
If there are no more questions, Jacinda, maybe we have a few minutes left. Maybe one of our panelists has a comment or question related to tonight's topic that they want to share in a minute or so.
Hey, Gerald, this is Gerald Brown. Can you guys hear me okay?
Yes.
Okay, first of all, you guys that are listening, you guys have really benefited from two incredible folks that I know quite well, that understand the market, and they provided some great information. The one thing that I would add, and for those of you who don't know, I'm Gerald Brown. I've spent 47 years in the banking industry. Joe and I go way back, having worked in insurance, and with my new friend Justin, who I've known for a few years in investment. I do have a perspective on a couple of things. And the one thing that I will also say is the question around you know, whatever return you wish to get, whether you're a senior, do not discount the importance of looking at your overall portfolio and managing your debt. I know Joe mentioned it, Justin mentioned it, you know, to some extent, but don't think that you can invest a lot of dollars and let's get 8% on your money when you're paying credit cards at 25%. You're still going backwards by 17%. So you want to make sure that whatever investment you make, sometimes the best investment is to invest in you minimizing your debt. And when you can come down off your debt, then whatever you save is a dollar amount that's going to go back into your portfolio to save, to invest in a manner that's consistent with your financial goals and your priorities. So I would always put a great emphasis to put on your financial planning hat, which is going to be looking at asset, income, liability, and expense. You know, the basics of accounting, I think in that respect is going to make a big difference. The question about the guarantee, there is no such thing as a guarantee in the market. I just want to make sure there's so many predictive models, but there are things happening in the marketplace today that we didn't foresee. So all the variables never considered COVID. Some of the variables did not consider the supply chain to the extent that we can't get food, we can't get clothing. The cars that you see on a car on the lot today may not even have a chip. It's all for show. The labor force to drive trucks to get to the retailers are diminishing. There is so much in the marketplace. So I would urge you guys, and Justin said it, you know, risk tolerance is going to be real key. The other thing too, I'll close with, Joe, is a lot of folks have asked me over the years, how long does it take to double my money? And I'm not sure if anybody addressed this. I got a little bit late, Joe, but there's something called the rule of 72. And what it is this: if you get 8% of your money, it's going to take 9 years for it to double, because 8 times 9 is 72. Yeah. If you get 6% of your money, it's going to take 12 years, because 6 times 12 is 72. It's generally directive, but it gives you a sense of how long it's going to take, you know, for your money to double, net your risk tolerance and some of those kinds of things. For the older population, I fit in that space. I'm clearly a baby boomer. You know, there's a lot of what they call actuarial analysis, you know, based on how long they might predict we might live. And, you know, you want to make sure you set aside money to have some fun and enjoy life. It's not always about investing in terms of return on the investment. Sometimes the best return is to invest in yourself and enjoy the niceties of life with your friends, your family, and pursuing the kinds of things that you're excited about.
Thanks, Daryl, for that insight. And I just want to take another opportunity to thank Joe Haywood and Justin. Caprice, you have something you want to say real quick? We got 3 minutes.
Real quick. I just want to say that, you know, I know all of these great authorities here would agree with me that it's not what you make, but what you keep.
Absolutely.
And so when you're thinking about investing, make sure you understand, you know, the tax implications. Also be aware that our economy is based on business building. And those of us, which I think practically every person on this call has their own business, you know, the tax code is based, it favors people who are in business. So when you're looking at the alternatives for your career, and then, you know, you may want to consider investing in yourself and becoming a business owner. Maybe a little riskier than working for a Fortune 500 company, but there's a lot of advantages to having your own business. And I think we're going to see more and more of that as a result of COVID-19, and a great change in the economy and the employees that work for various businesses. So think about investing in yourself.
Thank you so much, Caprice. We might go 2 or 3 minutes over time, but David or BJ, if you have a comment, now would be the time.
Oh, Joe, he has something.
Who was that?
I have something to say.
Okay.
I really, really want to emphasize this. Please do not be afraid to have discussions about death, because you need to talk about not just life insurance, but you need to have a living trust. You need to express where you want all your assets to go should something happen to you. And if you have a living trust, make sure you talk to your financial advisor. I ask clients all the time, do you have a living trust? because your account needs to be put in that trust in order to avoid probate. If you don't tell us, then Justin and I are just sitting there with you, with your money in an individual account. And if something happens to you, it's going to take months now to get it, as opposed to if it were registered to the trust or transferred on death to the trust, you could have got the money much sooner. So not just for you, you need to have that discussion with your parents. You know, if your parents are alive, discuss things so that families aren't feuding and fighting over assets, because they are going to fight. So I'd rather you settle it right now up front while everybody's alive, so there's no issues in death. Because the last thing your loved ones wanted was the whole family to fight, right?
That's right, Joe. I'm glad you brought that up. As ministers, we are in the middle of that fight quite a bit. So that's a very important point, Joe. We're running out of time, or we're actually a little bit over time. I just want to say that Michael Lawson got called away on an emergency, so he wasn't here to give us his point of view. But if you want to hear something about Michael Lawson and the Urban League and the great things that they're doing today, including BWAR, this Saturday at 7 a.m., KBLA Talk 1580 AM, Michael Lawson and Brian will be on Urban Family Focus, which is a talk show that I host on 1580 Talk every Saturday morning at 7 a.m. And you'll be able to hear all about the great things that the Urban League is putting forth. So with that, I'd like to thank everybody for attending tonight. We hope, well, I know you got some great information. I hope you put it to good use. And I want you to tell all your family and friends who haven't registered for BWARP to make sure they do, and log on for our December 8th BWARP, which is entitled Millionaires Millennials. Millionaire Millennials. And again, Catherine, Justin, and Jackson will be here Kevin Jackson will be here to share some great things from a millionaire millennials perspective. Thank you for tuning in to BWARP tonight. We hope you got something out of spending your time with us, and we hope to see you again on December 8th. Thank you so much.
Bye.
Bye now.